If you import goods from your own overseas subsidiary, your corporate tax team and your customs compliance team are secretly at war. And if they do not get on the same page, your company is going to be hit with a massive audit penalty. Welcome back. Today we are diving into one of the most complex, expensive, and misunderstood areas of global trade: the clash between transfer pricing and customs valuation. This is the ultimate related party trap, and it catches multinational companies every single day. Imagine your company is headquartered in the UK, the US, or the EU, but you own a manufacturing facility in Asia. You are essentially buying goods from yourself. When that Asian factory ships a container of products to your headquarters, they have to put a price on the commercial invoice. This is known as your intercompany price or transfer price. This is where the nightmare begins. Your corporate tax department, the people dealing with the IRS, HMRC, or local tax authorities, wants to optimize your global corporate income tax. They usually spend hundreds of thousands of dollars on a massive transfer pricing study that dictates exactly how much profit should be left in the manufacturing country versus how much should be reported in your home country. But customs authorities do not care about your corporate income tax strategy. They care about import duty. When customs sees that the buyer and seller share the same parent company, they consider you related parties. A massive red flag instantly goes up in their system. They automatically suspect that you artificially lowered the invoice price on those goods just to pay less import duty at the border. Here is the fatal mistake that 90% of multinational companies make. When a customs auditor knocks on the door and says, "Prove to me that this invoice price is fair," the company's CFO confidently hands the auditor their corporate transfer pricing study. They think, well, the National Tax Authority approved this pricing model, so customs will definitely accept it too. Absolutely not. Customs authorities operate under a completely different set of laws called the WTO Customs Valuation Agreement. They use entirely different legal tests to determine if a price is acceptable. A transfer pricing study focuses on aggregate profit margins over a whole fiscal year. Customs valuation looks at the specific transaction value of a specific shipment on a specific day. A tax study alone will not save you from a customs penalty. It gets worse. Let's say at the end of the year, your corporate tax team realizes they need to adjust the transfer pricing to meet their targeted profit margins. They issue a retroactive true-up payment, sending an extra $1 million back to the factory in Asia to balance the books. Did you declare that extra $1 million to customs? Probably not. Because you didn't, you just inadvertently committed valuation fraud. That retroactive $1 million was technically part of the price paid for the imported goods throughout the year, meaning you owe import duty on it. So, how do you fix this massive liability? You must bridge the gap between your tax department and your supply chain team. They cannot operate in silos. If your company uses transfer pricing, you need a formal, related party valuation defense file prepared specifically for customs. You must legally prove that the corporate relationship between the buyer and the seller did not artificially influence the price of the goods. You need to apply specific customs logic, utilizing the test values method or the circumstances of sale test to defend your invoice price. Do not wait for a unified government audit where both the income tax and customs authorities come after your margins simultaneously. Check your intercompany invoices today. Are you buying from a related party? Drop a comment below with your industry, and let's discuss how to build a bulletproof valuation defense file. Thanks for watching. See you in the next video.